The replacement property is identified within 45 days after you have property. All the proceeds go to the qualified intermediary, who in turn will forward it. So can I give it, what we're going to do with this one, as Glenn pointed out, is we're taking an example of a potential tax return that's includes a 1031 exchange. We're kind of build a little bit around it and also kind of revisit what a 1031 exchange is. So part of it for basic background is this is a tax deferred exchange. That's a process that allows the taxpayer to exchange one investment for another investment with the idea of deferring capital gains. It also provides an opportunity to defer the recapture that's associated when you have an investment property that's related to depreciation. So it's kind of those two things that is a nice benefit of this tax deferral. But you do have to keep in mind that there are some basic rules associated with this process of doing it. You just can't just buy a property, sell a property. Oh yeah, let's call it a 1031. You actually have to go through a qualified intermediary to actually make that happen. Go ahead, Glenn. So what are the benefits of doing this tax deferred exchange? For us, what we're looking at is the deferral of the sale of the property used in the trade or business. So really you're looking at, for a lot of folks, it might be just rental property. It could be somebody might have a commercial business, things that where you make money off of. That's really kind of the idea. So you're kind of going from one property to another. Okay, but you're looking at investment properties, so they have to be sort of similar. You just can't say, well, I'm going to get rid of my house and I'm going to buy a yacht. Maybe not, unless it's a racing yacht. Maybe we can, well, let's not get sidetracked. Tax deferral where the carryover basis rolls into the replacement property. And that's probably a really big one there. Go ahead, Glenn. So here's part of those qualifiers that we were talking about earlier. The exchanger, that's the person who's basically selling the initial property who wants to do this 1031. He has some replacement property that he's going to want to eventually consider acquiring. But what happens is he has the relinquished property, and I think this is where I might have made a couple typos here. The replacement property is identified within 45 days after you have, in a sense, put in contract the property you're relinquishing. So really the key to all this is that if I have a duplex that I'm going to sell, that's my relinquished property. I'm looking at buying a triplex, that's my replacement property. I got to close on the replacement property within 180 days. But the thing that starts that is once I have the relinquished property under contract, I have to identify the replacement within 45. So this is why we're looking at this 180-day window. It's real key. Yeah, you could do it as fast as a week. I've actually encountered a situation in the past week or so of someone who has done that. I've not seen it before. It's a first, but then again, I bought bare land and closed on it in 2 weeks. So depending on how you do it, if you do it in cash, usually things can change quite differently. Here's a graphic view of looking at that 45 and 180 days. The 45 is part of the 180. So in other words, it's 45 plus 135. That total is 180. When we do this, the person who's selling, because he's going to be a buyer as well as a seller, has to work through a qualified intermediary. He can't just go out and buy and sell and say, okay, let's go slap this together. No, when he sells the initial property, all the proceeds go to the qualified intermediary, who in turn will forward it to the closing of the replacement property or the eventual seller. Go ahead. Again, if you look at it, you can think of it in this way. How many people are involved in the actual process? Keep in mind that one of them is the qualified intermediary. The other one that's involved is the person who is relinquishing a property. So if I am representing Jack and Jill and I want to sell my rental property, I represent Jack and Jill, and that's one party. The buyer who's buying the property from Jack and Jill is a second party. When we look at the qualified intermediary, that's the third party. And then when we look for the replacement property, the person who's selling it to us, Jack and Jill, we're now involved with a fourth party. So technically you have 4 individuals or 4 parties involved to make this like-kind exchange work. The real key is the qualified intermediary has to be involved in order to make this satisfy, so the IRS doesn't scream and holler and jump up and down at you. So what are some of the advantages? The ability for a taxpayer to sell income or investment or business type property and replace it with a like-kind replacement without having to pay federal or state income tax. And what's also important on this is to keep in mind that if you have a rental property as an example, it does have depreciation. So normally when you sell investment properties, you would have a recapture of that depreciation, but not with the Section 1031 exchange. So what's a disadvantage? Well, as we know, when we have investment property, we're doing depreciation. When we look at the replacement property also is going to be depreciated just like the relinquished property. However, based on the rules associated with the 1031 exchange, what happens is the depreciation schedule of the relinquished property continues on until it ends. And the replacement property's depreciation schedule is, yes, 27.5 or 39 years, depending on if it's residential or commercial. But its value is not based on the value of the acquisition. It is based on kind of the differential between what did I sell and what did I buy for. And we'll show that in our examples going forward. Go ahead, Glenn. So here we go. We're going to work with Jack and Jill. Jack and Jill are married filing joint taxpayers. They really have no ability to itemize. There's no Schedule A. They're going to make about $130,000. They participate in the 401k plan. So far, a very basic return that we know. Here's where it becomes somewhat complicated, but it's still a relatively easy return. They have a duplex that they have rented out. So we know we're going to have a Schedule E, but they sell the duplex about mid-year. Through the life of the duplex, they made no improvements. So we don't have any capital adjustments with respect to the purchase price. They decide to go out and purchase a triplex, but they're doing it through this 1031 exchange. And of course, towards the end of the year, they're going to have triplex rental property income. So in other words, they're taking a duplex, going to a triplex. Does that satisfy one of the rules? Yes, we are buying something that is more expensive than what we're selling. And we'll see as we go through here. So if we look at this, the Schedule E that you see here shows the 2 properties in play. Column A is the duplex, column B is the triplex. And what we had as our example here is that the duplex was about 6 months and the triplex was, you can say about 2 months or so. But we wanted to show here income, insurance, property taxes, any kind of management fees. We wanted to see that there was rental activity here. Now, based on this one here, you'll notice that the bottom line shows that there was about a $6,200 loss with the 2 properties combined for the year. Go ahead, Glenn. Now, what we tried to do is buy the numbers. It's kind of like figure out what's going on. So when we look at this, that the initial property was purchased for $500,000 and its cost basis, because you know you can't depreciate land, I still think you could if you're living right next to 3 Mile Island and it's all contaminated swamp area, but that's another story. In the eyes of the IRS, they're saying you cannot depreciate land. Land never goes to zero, but improvements can. So we look at a $500,000 property, we have a 375 cost basis because we're suggesting that the land is 125. Over the 3+ years, we have an adjusted basis based on, I think, Glenn, you're getting ahead of me.
Oh, I'm sorry.
We have an adjusted basis down to 328 because that's the value of the depreciation taken over the period of time from the acquisition of the duplex. When we look at that, we have an adjusted basis that based on the purchase price, meaning purchase price less depreciation gives us an adjusted basis of 451. When we look at capital gain, the capital gain is kind of broken down into two components. And how we know about this capital gain is we're selling the property at 725. We bought it at 500. So you have a $225,000 gain there based on what? Okay, buy low, sell high, right? But we also have depreciation recapture of $46,000 worth of depreciation stuff. As we move forward, we also look at that there is identification of a realized gain that's in play here. And kind of when you look at the realized gain is you're looking back through, okay, well, if I got 270,000, how do I get my realized gain? Oh, that would be, what did you sell the property for against the adjusted basis at the time? So there's kind of two sets of numbers to look at there. Now to the right side, what we're looking at is we're looking at the replacement triplex. The replacement triplex is about $800,000. We find that of that $800,000, 225 is land. So we're not going to depreciate that. So we say, oh, do we depreciate on 575? Here's where we say, hold the bus. No, that's not true. As I talked about earlier, you have the $800,000 purchase price and the relinquished property was 725. What's that differential? 75,000. That's what your depreciation schedule will be based on, is that 75,000. Go ahead, Glenn. Now, when we looked at this, we have some dates in play that are part of part one of the 8824 form. And we have identified here that we acquired the duplex on January 6th of 2019. We went and turned and sold it on June 25th of 22. We were able to identify the replacement property in less than a month on July 15th of 22, and we closed on the replacement property in October 15th of 22. So when you look at the 180 days, 180 days is going to be between that, what? June 25 through October 15. And 180 days is roughly 6 months. This transaction didn't take a full 6 months, it was less. Go ahead, Glenn. Now from here, we're actually filling out the realized gain and loss, or part 3 of the 8824, to kind of figure out what's going on. And with it, 16 and 17 are where we're working at initially, where we see 800,000. Well, everybody says, well, fair market value of the other property given up. No, you don't really have that. What we mean by that is that, what if you were trying to sell the duplex and you were going to throw in a yacht, and that was how you're going to get your triplex? Okay, that sounds a little far-fetched, but I know somebody who had an RV, who sold an RV to buy a single-family home. So yes, it's conceivable, depending on financial situations, that can be done. But we don't have any other property we're adding in with the house or duplex that we're selling. So we don't have a value that sits anywhere in the top part of this form. Basically, 12 through 15 is 0. When we go to line 18, back Glenn, back one, there we go. When we go to line 18 identifies 529,912. And how we kind of get there from here, and this is where it starts to get a little bit complicated, so we try to break it down here in a little red square for you. we look at it and we say, okay, this has a value and it's made up of 4 basic pieces. One of them is associated with what did I purchase the price for less the depreciation. So I have an adjusted basis. Then a lot of times when you have a 1031, you have exchange expenses. And so we have a value of exchange expenses if you see on the top right portion of the red square. Now, the next piece is talking about net cash received versus net debt incurred. When we're looking at a 1031 exchange, kind of the 3 basic rules is that, okay, if I buy a property, is the replacement property greater in value than the relinquished property? Is the replacement property debt service greater than the relinquished property debt service? So you can kind of see where we're kind of going with this. In other words, you want to come in the eyes of the IRS, they're basically looking at you as if you're investing, yeah, probably you're going to get further in debt on paper. So we're going to cut you the break in the sense of having to pay taxes on this stuff. We're just going to roll it forward. So in our example here, we see that the duplex was sold at $725, but we had an outstanding loan there of about $317. So you can see your number would drop down to $400,000. Then we looked at the replacement property of $800,000, and in the process of doing that, we were taking on debt of over $400,000. So in this example here, there is a little bit of a difference, but you'd say, oh, well, we're down about 15. A lot of times it would be higher. In this case, why it looks lower is because you got the 725 minus 317, that number, and then the 800 minus 407. Usually a lot of times the replacement portion is bigger than the relinquished portion. But moving on, we can clearly see that taking on the debt is such that we have 317 that was paid off and 407 we're acquiring. So when you put together the 453,000, the 1,500, think of it as a 15,000 coming back to you if you want to even think of it that way. And then the additional 90,000, that end results when you can pull it all together is at 529,000. So we can see that, yes, that is the adjusted basis of what we're giving up. And that's what line 18 is. So line 19 basically says, let me take 17, subtract out of that 18. When we roll down through the formula, because we didn't get any cash food here, we don't have to worry about 23, 22 portions there. Also, too, we're not selling this property. It's as the last final transaction. It's no, we're selling the relinquished property and we're buying a replacement. If we didn't buy a replacement, then we really wouldn't be doing a 1031 exchange. And then we would have the recapture, and that would come into play here. But we're not having to do that because recapture gets to roll forward as well as the capital gains and the taxation on that. In the end, we move forward on our tax return to the 1040, and the circle represents the rental property. The rental property income for the year was, as we said earlier, was about a $6,000 loss. And the 130,000 that Jack and Jill made was reduced down to 124. Sure, we have their standard deduction, and at the end of the page 1, we see that they're about 98,000 on the return. Go ahead, Glenn. Thank you. When we look at that amount of taxable income, we can see is $12,900. We can see also too that the amount coming out of their W-2 is greater than, so they get a refund. This is a nice thing about this is that you notice you see no depreciation recapture running through here. You see no capital gains taxing in here. If you did, it would be up in the tax and credit portion up at the top, where we're looking at basically, I think you would see it under Schedule 3 there. We don't have any of that there. This is what's nice. If we were doing any boot as an example, and that is, there's no official explanation of boot in the IRS tax code, it's just what it's been called. For all intents and purposes, that's if you sell the property and you take any of the cash in hand when doing a 1031 exchange. that becomes taxable. Think of it like taxable income. The other thing about when you're doing the selling of property, if you have capital gains, you have the potential based on level of income on that capital gains to be taxed as high as 25%. So this is what we're trying to avoid. Go ahead, Glenn. So when do you report the exchange to the IRS? And this is one of those things that's really important, that if you have one that's all in the same calendar year, you're okay. But what if you have a situation where your properties that you're relinquishing and the one you're trying to replace and close cross calendar years? The recommendation is you don't file a tax return until all the properties have been received, meaning everything has been taken care of, where you have closure on the sale, closure on the buy. If that means you have to file an extension, file an extension. The IRS would prefer that because they want to see all the transaction happen on one tax return. The 1031 exchange doesn't cross multiple years. It's only dealt with 1 year. Go ahead, Glenn. So with the depreciation recapture, everybody wants to know, well, what happens with that? No, we don't have to do the 4797. We don't have to do the Schedule D. No, that's not in play here. But the answer is really easy. It's just like the capital gains, it's deferred. So we don't have to worry about it. So this is what's nice about the depreciation, the recapture and the capital gains. They get kind of kicked down the road, if you may. Eventually, there'll be a point where you're going to have to deal with it, and that's going to come through as a Section 1250 gain. And we know at that point in time, you're going to get subjected to potentially as high as 25% on it. Meanwhile, the cost basis is also carried over to replacement properties. So the IRS doesn't allow us investors who are doing this stuff to change the depreciation schedule. So they really don't want you, oh, okay, I have a $500,000 property, I'm going to create that depreciation schedule. Oh, wait a minute, I bought an $800,000 property, I want to create that. No. That's why the old depreciation schedule continues forward. And the new add-on depreciation schedule is going to be the differential between the relinquished sale and the replacement purchase. Go ahead, Glenn. What we tried to show you here is an example of that. When we talked about earlier that the depreciation schedule technically for the replacement property would be less, it's kind of designed that way. But if we look at what we have here for the duplex had the 27 and a half year schedule. 28 is the, we know it's 28, but for all intents and purposes, what we see is when we look at the schedule, we know that if we were looking at 2022 and did the full year depreciation, we'd have 13,635. If we look at the replacement property based on the 75,000, that depreciation is about $570. When you combine the two for the purposes of taxes for the 22 tax year, you'd have a combined of $14,203.50. If you went over and looked at the replacement property, but based on the adjusted cost basis, you notice that the depreciation schedule is much smaller. Eventually, what you find down the road is that it is better to leave it as you see it here than to say, well, I need to change my depreciation. No, because the 1031 doesn't really play that way, but there could be some exceptions to that. Basically, the IRS does not allow the investor to start a new depreciation schedule on the replacement property. We're really looking at the differential between the sell and buy. And that's really, if you want to call that a new depreciation schedule, you can. But really, that is the upping of the depreciation associated with the exchange. Taxpayers basically continue with the old schedule, but they have to do this added cost basis depreciation schedule. Go ahead, Glenn. Now, we learned in 2007 that there's been some IRS amendments, and under these regulations, the general rule remains that the taxpayer must depreciate the remaining relinquished property adjusted basis, or the remaining recovery period using the same depreciation method as if they were continuing it. In other words, we had the duplex, we had it for about 3.5 years. We had utilized the 3.5 years, quote unquote, on the depreciation for it as our adjustment of cost basis. Great. However, we get to utilize the remaining period of depreciation going forward, because that's what we have here from this. Go ahead, Glenn. However, the replacement property is not residential, and he was kind of one of those little exceptions. Then the remaining exchange basis and the new excess basis would be depreciated over a 39-year schedule. So what if you bought a commercial building and you had relinquished a duplex? There's a difference now. And even though technically they're investment properties, a commercial building has a 39-year schedule versus a residential unit, which has 27.5. So here we can kind of see that we can have a little bit of game playing with respect to, how do we track things now through the depreciation schedules? Any increase in the no depreciation is claimed between the transfer of the relinquished property and the receipt of the replacement. So you notice when we were doing this initial Jack and Jill sell and buy, they had closed in June and on the sale, and then closed on the buy in October. In between June and October, that part of the old schedule cannot be used depreciation wise. So you'd actually have to kind of sit down and do some calculations to reflect that gap of time.